Hey everyone, welcome back for another deep dive.
Yeah, glad to be back.
Today we're talking about a true legend in the investment world, Benjamin Graham,
Oh, absolutely.
and his book, The Intelligent Investor. I mean, this is like, if you haven't read it, go pick it up. But
Required reading?
seriously, yeah,
For sure.
it's one of those books. So
Yeah.
we're going deep on chapter 6 today,
Okay.
where he really gets into how to build a solid investment portfolio.
And what's fascinating is he doesn't start by telling you what to buy.
Really.
He tells you what to avoid.
He takes like a negative approach.
Yeah.
Which I got to admit, that sounds a little counterintuitive at first, you know?
I can see that.
You want to be out there
Yeah.
hunting for the next big thing, the next Apple or a Tesla or whatever.
Right, of course, but
And he's telling you, no, pump the brakes a little bit.
think about it this way. Every time you say yes to one investment,
Okay,
you're essentially saying no to countless others, right?
that's true.
That's opportunity cost. And what Graham's saying is sometimes the most important decisions are the ones we don't make.
Okay.
Avoiding those big mistakes, that's even more crucial than chasing every potential winner.
So it's more about protecting what you have
No, exactly.
than just going after every shiny object, right?
It's like being a good poker player.
Okay.
Sometimes the best hand is the one you fold.
Knowing when to hold them, knowing when to fold them.
Exactly.
So where do we even begin? Like, what are some of those red flags Graham wants us to watch out for?
Well, he's got some pretty specific warnings.
Okay.
And a lot of it comes down to things like second-grade bonds, preferred stocks,
Okay.
especially when people are chasing those high yields.
Yeah, like reaching for that extra return.
Right. And he uses this great phrase. He calls it a businessman's investment.
I love that. A businessman's investment. What does he mean by that?
Well, it's this idea that you think you're being all savvy, going after that slightly higher return, but
You're overlooking the risks.
exactly. It's like walking a tightrope for a slightly bigger prize, but not realizing how much further the drop is.
And sometimes it's not even that much bigger.
Right. And Graham was really adamant about this, accepting a slightly higher yield
Okay.
while significantly increasing your risk.
Yeah.
That's a recipe for disaster.
He called it bad business.
Yeah, and I think that's such a great way to put it.
Yeah, absolutely.
Because at the end of the day, it is about business, right?
It's about protecting your capital
Exactly.
and making smart decisions.
And he's got this great example from the railroad industry.
Oh, yeah. Tell me about that.
Back then, railroads were considered like the blue chips of their day.
Right. Everybody used railroads.
Exactly. So you might think, okay, railroads, that's a safe bet.
Solid industry.
But even within a solid industry, there are those riskier investments.
Okay.
And he points to these 10 specific railroad income bonds.
Well,
They all started out priced at 96 or higher.
okay.
So people thought they were getting a good deal. But then, between 1946 and 1947,
Oh,
they completely tanked.
wow.
The average low was just 68.
So even if the industry seems solid, you could still get burned on those riskier bonds.
Precisely.
It's not just about the what, it's about the how as well.
Exactly. And that actually leads us to another area where Graham urges a lot of caution.
Okay, I'm intrigued. What is it?
Foreign government bonds.
Ah, yes. The allure of exotic investments.
Right. Everyone loves the idea of, getting in on the ground floor of some booming economy.
Right, those emerging markets.
Exactly.
But Graham's point is, historically speaking, those foreign bonds have been a bit of a roller coaster, haven't they?
Oh, absolutely. And you got to remember, he was writing at a time when things were really turbulent.
Right, this was post-World War I.
Exactly. Since 1914, there had been all this upheaval in the bond market.
Wars, revolutions, all sorts of things.
You name it, political risks, lack of investor protection. It was a minefield out there.
Okay, so he's saying tread carefully.
Be very, very careful.
Give me an example, like what's a real cautionary tale from that era?
He talks about Cuban bonds in the 1950s.
Cuban bonds, okay.
These things were trading as high as 117 at one point.
People thought they were sitting on a gold mine.
Right. But then, boom, default.
What happened?
Crashed all the way down to 20 cents on the dollar.
Wow, talk about a haircut.
That's a buzz cut, my friend.
So that really highlights the importance of really understanding those geopolitical risks.
Absolutely.
Not just getting caught up in, higher potential return.
Because that higher return can disappear overnight.
And what's interesting, he also talks about how the U.S. was actually dealing with its own balance of payments issues back then.
Right.
And part of that was because investors were chasing those higher yields on foreign bonds.
Exactly.
It's like this vicious cycle.
It's all connected,
Yeah, it's all connected.
What seems like a good deal in one corner of the world can have ripple effects everywhere.
So lesson learned, Be wary of those foreign bonds, especially when things are looking a little shaky on the global stage.
And maybe even when they're not so shaky, it's all about careful consideration.
Right, due diligence, all that good stuff.
Exactly.
And speaking of things that can seem too good to be true,
Oh, I know where you're going with this.
those new stock offerings, the IPOs,
Everybody loves an IPO.
it's like the investment world's version of a red carpet premiere, right?
Champagne, confetti, everyone's dressed to the nines.
Exactly. But Graham was pretty wary of IPOs, wasn't he?
He was extremely wary, especially during those bull markets.
He saw them as what, like, inherently risky.
Inherently risky, often fueled more by hype than by, actual solid fundamentals.
And to think, he was writing this back when IPOs weren't nearly as common as they are today.
Oh, I know, right? Imagine what he would say now.
It'd be like, hold your horses, everybody.
Exactly. He saw two major dangers with IPOs.
Oh, okay, lay it on me.
First, there's often a ton of, salesmanship pushing these things.
Right, got to get those stocks out there.
Creating this artificial frenzy.
So you're already walking into a situation where emotions are running high.
Exactly. And the second danger.
Yeah, what's the second one?
They often launch during market peaks.
Ah, so you're not only dealing with the hype, but you're also potentially buying at a time when valuations are already stretched?
Exactly.
Double whammy?
Not exactly a recipe for success.
Okay, so if you're thinking about diving into that next big IPO, maybe take a beat. Remember Graham's advice.
Take a deep breath, do your research,
Don't get caught up in the frenzy.
because it's easy to get swept up in the excitement, but
It can be a costly mistake.
it certainly can.
And Graham, he's got some pretty vivid examples to illustrate these dangers.
Oh, he doesn't just talk the talk, he walks the walk.
Give me one. Hit me with a cautionary tale.
Okay, how about Aetna Maintenance Co.
Aetna Maintenance Co. I vaguely remember them. What happened?
So their stock was initially offered at $9 in 1961.
Okay, $9 a share.
It shoots up to $15.
Everybody's feeling good.
Right, people are thinking, I'm a genius.
I'm going to retire early.
But then 1964 rolls around and
Yeah.
the stock plummets to 78.
Wow, from $15 to less than $1.
Classic boom and bust.
A reminder that just because something goes up quickly doesn't mean it's going to stay there.
What goes up must come down, especially in the stock market.
And sometimes it comes down hard.
And speaking of coming down hard, there's another example even more dramatic.
Okay, this is going to be good. What is it?
AAA Enterprises.
AAA Enterprises. All right, what's their story?
Shares initially started trading at $28.
$28. Okay, not a cheap stock to begin with.
Not at all. And people piled in thinking this was the next big thing.
Oh,
Then the bottom fell out.
How far down did it go?
Try 25 cents a share.
Oh my goodness, that's brutal.
It's a reminder that in the stock market, you can lose everything.
Yeah, and unfortunately with AAA Enterprises, it wasn't just a paper loss.
Right, the company ended up going bankrupt.
So those are some pretty sobering stories.
They are?
Makes you almost want to just, take your money and stuff it under the mattress.
Well, luckily, that's not what Graham's advocating for.
Okay, good, because I was about to say, that doesn't sound very profitable.
He's not saying don't invest. He's saying invest wisely.
Be smart about it.
Exactly. And his advice, it's really about equipping you to navigate those potential pitfalls.
So it's not about being fearful.
No, not at all.
It's about being informed.
Informed and strategic.
Taking off those rose-colored glasses.
Absolutely. Don't let the fear of missing out drive your decisions.
FOMO, the silent killer of portfolios.
And a lot of times it comes down to this idea of market timing.
Which, let's be honest, is notoriously difficult.
Trying to time the market perfectly is like trying to catch lightning in a bottle.
It's almost impossible to do consistently.
And even the professionals get it wrong all the time.
So what's the alternative?
Well, Graham's negative approach is a good place to start.
Okay, so instead of trying to time the market perfectly, what should we be doing?
Focus on what you can control.
Which is
Your own decisions.
your own due diligence.
Exactly.
Understanding the businesses you're investing in.
Looking at the fundamentals.
And not getting caught up in the hype.
Because hype is fleeting, fundamentals are forever.
I like that. I'm going to write that down. Hype is fleeting, fundamentals are forever.
There you go. Little Graham wisdom to live by.
So if we take a step back and look at everything we've talked about today, all this advice from Graham,
Yeah.
what's the key takeaway for our listener who's, maybe feeling a little overwhelmed by it all?
That's a good question.
Like, what's the one thing they can take away from Graham's negative approach?
I think it's this. While the specifics of the market might change, new industries, new technologies, the one constant is human behavior.
People are still people.
Exactly. We're still driven by the same emotions, the same biases.
Fear and greed.
Exactly.
So those pitfalls that Graham identified decades ago, they're still relevant today.
Because we haven't really changed that much as a species.
We're still making the same mistakes,
We are.
getting caught up in the same hype cycles.
It's human nature.
So Graham's negative approach isn't just about avoiding certain types of investments,
It's about recognizing those patterns of behavior.
recognizing those pitfalls,
Exactly.
and having the discipline to say, no, I'm not going to fall for that trap.
It's about building those mental guardrails
Mental guardrails. I love
to
that.
keep you from veering off the road.
Especially when the market feels like a runaway train.
Exactly. And that's something we can all benefit from,
Absolutely.
no matter how much experience we have.
No matter where we are on our investment journey.
It's about being a student of the market,
Always learning.
always evolving.
I love it.
It's a lifelong pursuit.
Well said.
Well, hopefully that gives our listeners a good starting point.
Yeah, I think that's a great foundation.
From there, it's all about putting in the work
Doing your research, staying disciplined.
and remembering those timeless principles,
Timeless principles from Benjamin Graham.
the godfather of value investing.
There you go. All right, so on that note, let's take a quick break, but we'll be right back with more insights from Benjamin Graham.
Sounds good.
Stay tuned. It's like having that little voice in your head saying, hold on a minute, let's think about this.
Oh,
When you're about to, jump into the latest hot stock or whatever.
yes,
Yeah.
exactly. Having that inner skeptic,
Yeah.
that's key.
Your inner Benjamin Graham.
There you go.
But I think it's important to remember here, this negative approach we keep talking about,
Yeah.
it's not about being afraid to invest.
No, not at all.
It's not about being overly cautious or risk averse.
It's about being smart with your money.
Exactly.
It's about being a more discerning investor,
Okay.
not just jumping at every shiny object that comes along.
So it's more about protecting what you have
Yeah,
and making sure those decisions are based on something solid,
exactly.
not just emotions or gut feelings.
Because let's be honest, emotions and investing, they don't always mix well.
No, they really don't.
Sometimes they do.
Sometimes,
But more often than not, they lead you astray.
right. It's like that fear of missing out, FOMO.
Oh, FOMO, the worst.
The worst, yeah, when you see everyone else making money
You feel like you're just going to get left behind.
and you got to get in on the action,
Exactly.
even if you don't really understand what you're getting into.
And that's a recipe for disaster.
Yeah, it's like you're more likely to buy at the cup.
Oh, absolutely.
And then when things inevitably correct,
You're the one left holding the bag.
yeah, not a good feeling.
Not a good feeling at all.
So Graham's negative approach, it's kind of like a defense mechanism against those emotional impulses.
It's like having a good set of brakes on your car.
Okay, I like that.
You can still go fast.
You can still have some fun,
Exactly. But you can also slow down when you need to.
control the situation.
Exactly. And I think a great real-world example of this, something that a lot of people can probably relate to.
Okay, yeah, give me an example.
Think about the whole cryptocurrency craze a couple years back.
Oh yeah, that was wild.
Bitcoin, Ethereum, Dogecoin, all of that.
It seemed like everyone and their dog was buying crypto.
It was crazy. And the thing is, a lot of people, they didn't even really understand what they were buying.
Right, they just saw the price going up.
Exactly. And they got caught up in that frenzy, that fear of missing
The
out.
FOMO was strong.
Oh, it was off the charts.
And unfortunately, a lot of people got burned.
They did, because they weren't thinking clearly. They weren't asking those tough questions.
Like, what is this thing?
Right. What problem does it solve?
What are the risks?
What am I actually buying here?
They just saw dollar signs.
Yeah.
And they thought, I got to get in on this.
Which, in some cases, it worked out.
Sure, some people made a lot of money.
But a lot of people lost a lot of money, too.
Right, it's a high-risk, high-reward game.
It is. And that's not really what Graham's about.
He's more about minimizing risk.
Exactly. And maximizing your chances of success.
So how do we apply that negative approach to something like crypto, where it's so new, so volatile?
Well, I think it starts with education.
Okay, doing your research.
Exactly. Don't just jump in blind because everyone else is doing it.
Take your time,
Understand what you're investing in.
and if you don't understand it,
Don't invest in it.
simple as that.
Exactly.
That could have saved a lot of people a lot of heartache.
It could have, but hindsight is always 20/20.
That's true.
The important thing is to learn from these experiences.
So we don't repeat the same mistakes.
Exactly. And that's what Graham's trying to teach us.
With his negative approach,
It's about avoiding those pitfalls
making smarter decisions,
and building a more sustainable approach to investing.
long-term thinking,
Exactly. Because at the end of the day, that's what it's all about, right?
building wealth over time.
Not trying to get rich quick.
Because, let's be honest, those get-rich-quick schemes,
They rarely end well.
They rarely end well. They usually end with you getting burned.
Exactly. And that's what Graham's trying to help us avoid.
With his wisdom.
His timeless wisdom.
All right, so we've talked about the allure of high yields, the dangers of IPOs, the crypto craze.
A lot of potential traps out there.
A lot of traps, yeah.
Hmm.
But I think what's interesting about Graham's negative approach,
Yeah.
it's not just about avoiding losses.
Right.
It's also about identifying opportunities.
Because sometimes the best opportunities are the ones that nobody else is looking at.
The diamonds in the rough.
Exactly. And those diamonds are often found in the most unexpected places.
So how do we find those diamonds?
Well, it takes a certain mindset,
Okay.
a willingness to go against the grain.
To be a contrarian?
In a sense, yes, but not just for the sake of being different.
Right, not just to be contrary.
It's about having a well-reasoned, well-researched thesis.
And being able to articulate why you're zigging when everyone else is zagging.
Exactly.
Because sometimes the crowd is wrong.
And those are the times when you can really make a killing.
But it takes guts
It does.
to go against the herd.
Especially when everyone else seems so sure of themselves.
But that's where the real opportunities lie.
If you're willing to do the work.
The research, the analysis,
And have the conviction to stick to your guns.
even when it's uncomfortable.
Because that's what separates the amateurs from the professionals.
The Benjamin Grahams of the world.
Exactly.
It's like you got to have the courage of your convictions, right?
Absolutely. And, I think that's something that a lot of people, they struggle with that.
Yeah, it's easy to get caught up in the crowd mentality.
It really is, especially when you see everyone else seemingly making money hand over fist.
And you're like, well, maybe I'm wrong. Maybe I should be doing that too.
Right, exactly. And that's where that discipline comes in, that ability to step back and say,
Hold on, this doesn't feel right,
exactly.
even if everyone else is doing it.
Because sometimes the best investment is the one you don't make.
Ooh, I like that. That's a good one.
Write that down.
The best investment is the one you don't make. So we've covered a lot of ground today.
We have
Talked about a lot of different aspects of Graham's negative approach.
a lot of wisdom to unpack there.
It's a lot to digest,
Yeah.
for sure. So for our listener who's maybe just starting out on their investment journey,
Yeah.
what's one key piece of advice, one actionable thing they can start doing today
Ooh, one thing.
to become a more Graham-esque investor?
Okay, I like that. To become more Graham-esque, I would say this. Get comfortable with asking why.
Okay, why? I like it.
Don't just take things at face value.
Don't just follow the herd.
Exactly. Whether it's a hot stock tip from your brother-in-law.
Right, or that random guy on the internet.
Exactly. Or a glowing analyst report. Question it.
Question everything.
Why is this a good investment? What are the risks? What are the underlying assumptions?
Do your own research.
Exactly. Become your own financial detective.
I love that. That's a great way to put it.
Channel your inner Sherlock Holmes.
So be skeptical, be curious, be your own advocate.
And don't be afraid to walk away if something doesn't feel right.
Even if everyone else is telling you this is the next big thing, you got to get in now.
Trust your gut. If it smells fishy, it probably is.
And that takes practice.
It does. It's a skill you develop over time.
Learning to trust your own judgment.
And not being afraid to be wrong sometimes.
Because nobody's right all the time.
Not even Warren Buffett.
Not even Benjamin Graham himself.
Exactly. So cut yourself some slack. Learn from your mistakes.
And keep asking those questions.
Always be learning, always be growing.
Well said. And on that note of continuous learning and growth, we're going to wrap up this deep dive into the brilliant mind of Benjamin Graham,
He was a true pioneer.
a legend in the investment world, and his insights, they're just as relevant today
Maybe even more so.
as they were decades ago.
Because the fundamentals, they never change.
The fundamentals of human behavior, the fundamentals of investing.
Exactly. And that's what Graham's negative approach is all about.
It's about understanding those fundamentals
And using them to your advantage.
to build a portfolio that can weather any storm.
And achieve your financial goals.
So, as we always say on this show,
Happy investing.
happy investing, everyone.